Good day to all, and welcome to our weekly market updates provided by SC Securities Research. As always, we will be going over the major highlights of the stock market this week, as well as touching upon some of the macro factors, as well as looking at our secondary market, global commodities market, and rounding off with the global news before Harin takes you through the technicals pertaining to the all share and our pick of the week this week. So let's dive in. So the major headline is that the all share post positive growth, primarily driven by local demand. However, we see that foreign selling continues. So this week, the all share actually rose by 1.28%, whilst the S&P rose by 1.42% respectively. Turnover was somewhat moderate, but today we saw some significant turnover. The positive performance was primarily driven by local demand, especially by a combination of corporates and high net worth individuals or HNIs. And the share actually briefly crossed the 8,000 mark on Thursday before just settling below that mark at close. But however, in terms of somewhat of a blighting news is that we saw foreign net outflows for the week actually go beyond 2.5 billion. Now, yes, just today itself, 1.1 billion in foreign net outflows. So in terms of some of the major macro news, and this is something that trickles down. So yes, as we stated that over the week, we saw a huge foreign net outflow of 2.5 billion. The year-to-date foreign milestones of 27, 28, and 29 billion in terms of outflow were all crossed in a matter of 5 market days. And this still remains somewhat of a blight over the market, as it indicates foreign interest continues to wane, mainly on the back of a volatile macroeconomic situation that currently exists in the country. In terms of other news, despite the import restrictions that are currently in play in the country, imports continue to enlarge the country's trade deficit. So the trade deficit increased for its 3rd consecutive month. The external trade data released by the Central Bank of Sri Lanka showed that imports rose by close to 62% on a year-on-year basis for May, whilst exports rose by 52% on a year-on-year basis. In terms of some positive news, we saw that Sri Lanka's tea export earnings saw a 14% increase over the first 6 months of this year, on the back of a 10% increase in the quantity shipped compared to the year prior. In terms of the destination list, Turkey topped that said list, followed by Iraq and Russia. The latter, however, in this case, Russia, showed somewhat of a blight or somewhat of a negative in terms of the fact that its quantity demanded compared to this time last year is somewhat lower. This was, however, somewhat partially offset by exports to the UAE, more than doubling over the last year or so. In terms of our secondary market, there wasn't much activity going on. The bond auction held on Wednesday actually sold its full quantum of bonds offered. So 3 and 6 month bill yields moved up marginally, whilst volumes actually skewed towards the short end. As of 15th July, that is yesterday, the central bank actually holds 917 billion rupees worth of bills issued. This is mainly on the back of numerous bond auctions that failed to sell its full quantum, which resulted in the central bank having to print more money and buy that excess. In terms of the global commodity markets, we can see that gold actually increased this week, as well as aluminium. The gold spike is actually hit a 1-month high this week, spurred by the Fed statement a couple of days ago saying that there's still concerns or growing concerns over the global economy stalling, or the economic recovery stalling, on the back of the fact that the Delta variant cases continues to rise in different parts of the world. Aluminium saw a spike in prices as China's primary aluminium output fell in June for the 2nd consecutive month, on the back of limits being actually imposed on the power consumption in the smelting hub of Yunnan. Oil prices fell this week as concerns persist with OPEC Plus. As we discussed last week, OPEC Plus were looking to actually curb the supply of oil, and most of the countries within OPEC Plus had agreed to it. However, there was somewhat of an impasse because certain major players within that organization had trepidation. So that still continues. However, we still expect, as we've reiterated numerous amount of times, that oil prices will increase and will hit the $80 per barrel mark in the next coming months. In terms of global market news, markets came in mixed this week. The US second quarter earnings seasons has come across, showing some strong positives. If we look at some of the European stocks, they actually rose on Friday as travel stocks posted a rebound after an early slump. This was further driven by upbeat earnings reports that have somewhat overshadowed the concerns of rising Delta variant cases in Europe. The Pan-European Stock 600 index actually rose by 0.1%, and it's still on course to end the week on a flat or on a slightly lower trajectory compared to last week. The UK's FTSE 100 and mid-cap stocks rose, with Britain looking to relieve its restrictions on Monday. Whilst China stocks posted gains this week on the back of the central bank's decision to reduce the reserve ratio requirement from its bank in order to underpin or further drive the country's post-pandemic economic recovery. Overall, markets have moved sideways this week a bit. We have seen Chinese economy's expansion post-pandemic somewhat leveling off. Asian markets actually came in mixed on Friday, with the Nikkei actually slipping nearly 1%, whilst the Hong Kong Hang Seng rose slightly, and the China Composite came in 0.7% lower. Like I reiterated, it has been somewhat sideways this week on the back of strong US second quarter earnings seasons and the dovish rhetoric from the Fed. However, this has been also counteracted by the fact that there has been a slowdown in economic activity in China, and that is a cause for concern. Those are the main highlights for this week. I will now hand it over to Harin, who will take you over the technicals regarding the all share and our pick of the week this week, Expo. Over to you, Harin.
Thank you so much, Nuwan. So as I move on with the all share index, so the current RSI of the all share index is 72.96, and also we were able to see how index reached the level of resistance 7,958,000, which initially on June 29th it made a high of 7,956.01 and made a swing low formation, which is a structural low formation, again on July 2nd, making a low 7,630.37. And thereafter we were able to see how the index moving in a bullish momentum, reaching the daily resistance, testing it again, the key level, the daily resistance of 7,958,000. So as the RSI is also currently overbought, which is at 72.96, and also we were able to see as of Friday today somewhat around a rejection from the daily resistance, making a high of 8,024.45 and closing at 7,966.95. So if during the upcoming week, if the index continues to decline from this daily resistance, if it fails to break this daily resistance of 7,958,000, we will be able to expect the index coming down to the level of 7,821.39, which is also the February 19th high. So if the index manages to break and sustains over the 8,000 key level, we'll be able to test the February 15th high, which is 8,130.17, and also sustaining above 8,000 could potentially indicate that the bullish trend could further continue upwards. So currently the index is at a daily resistance and it is at a very crucial area, since 8,000 is a strong psychological area. So looking at the 8 and 18 EMAs, which is exponential moving averages, so the slow moving average and the fast moving average of course indicates a bullish momentum, since the index is trading above both the EMA levels. So moving ahead, Expo. So Expo, the daily RSI is 72.17 and it is quite overbought at this very moment, and the price manages to reach somewhat around near to the daily resistance of 55.56, and today's closing was 54.70. So it is quite overbought at this very moment, and we were able to see how previous daily resistance of 52.5 53 has been broken, retested. Now that it has become a demand zone, we 72.5 52.5 53, which is the daily support, and now it could potentially test the daily resistance 55.56, and a breakout from that region could initially move the price to the next daily resistance of 57.558, or else a continuous rejection from this area could potentially bring down the price again to the 52.553, moving forward. So basically, on somewhat around in June 18th, we were able to see a structure high formation, and again today, as of Friday, we were able to see that previous structure high has been broken and a new structure high has been made. So basically, structure low, which is a high low, is currently missing. So this could actually potentially mean that the price could actually, if it gets rejected from the daily resistance of 55.56, it could potentially come down. So the moving averages, of course, indicates somewhat around a bullish momentums in the price is also trading above the moving average, and also strong bullish momentum, as we can see as the trend line that I have drawn. We can see how that bullish momentum has been going for the past few weeks. So uh, basically, this daily resistance of 55.56 needs to be broken in order to go to the next daily resistance of 57.558. Else this could potentially indicate that it could come down again to somewhat around to the key levels, to the demand zones, 52.553, and a break. And also, if it manages to break that key area, it could potentially come down to the psychological area of 50.51. Thank you. Over to you, Nuwan.
Thanks, Harin, as always, and thanks again. Thanks to everyone who joined in for this session. As always, you can find this report on our client mail, and you can follow us on LinkedIn, YouTube, Facebook, and Instagram under SE Securities Private Limited. And we look forward to having you again next week for when we give our next weekly update. Take care, everyone.